Welcome back to the deep dive. I want to start today with a feeling.
Yeah.
It's that little voice in the back of your head when an offer lands in your lap that sounds just a little too perfect.
The impossible promise.
The impossible promise, exactly. You know the one. It's the can't lose investment, the secret formula that a friend of a friend has that's getting double-digit returns while everyone else is, struggling.
It's the financial equivalent of a perpetual motion machine. It defies the laws of physics.
That's it. And we're talking, of course, about Ponzi schemes. Now, before you think, oh, I know the story, it's Bernie Madoff or it's that Italian guy with the stamps, just hold on a second. Because looking at the mountain of research we have in front of us today, this goes way beyond a few famous con artists.
Well, absolutely. It's not just a few bad apples. It's a recurring bug in the human operating system, a structural flaw in our psychology when it comes to money and trust.
And that's really our mission for this deep dive. We're not just going to skim the surface. We're going to get the tools out and dismantle the machinery. I really want to understand how the engine of this thing actually works.
Because it's an engine that's been running for a very, very long time.
It has. And when you strip away all the fancy suits and the confusing jargon, what you're left with is a gap, a huge gap between a story, and it's usually a very, very good story, and a reality that is nothing more than, well, shuffling cash.
Shuffling is a very polite word for it. It's a carefully constructed mechanism of illusion.
Okay, so let's start with the absolute basics, but I want to push on it a little. The classic definition is robbing Peter to pay Paul.
Right.
You take money from investor B, you use it to pay a profit to investor A, and you skim a little off the top for yourself. But as I was reading through the prep notes, I just kept thinking, is it really that simple? I mean, how does something that simple last for decades? Like with Madoff, how does no one just check the bank account? It feels like it should fall apart in a week.
And that's the paradox. It sustains itself because it's that simple. The simplicity is the key to its resilience.
How so? That seems completely backwards.
Well, think about a real business, a legitimate company. It has 1,000 moving parts, right? You have supply chains, you have marketing, product development, HR, customer complaints. A million things can go wrong.
Sure. A bad quarter, a competitor moves in, a key supplier goes bust.
Exactly. But in a Ponzi scheme, there's only one variable that matters: capital flow. That's it. As long as the money coming in the front door is greater than the money going out the back door, the illusion holds. The engine keeps running.
So unlike a real business that has to actually create value, build a car, write a piece of software, sell a cup of coffee, the profit in a Ponzi is entirely fictitious.
100%. It's not profit. It's just a transfer of principal from a new victim to an earlier victim. The operator is just a middleman in a chain of theft, and they're taking the biggest cut.
But to get people to hand over their principal in the first place, you need that story. You can't just say, give me your money, I'll give you someone else's.
No, of course not. This is where the operator has to be a master psychologist. They build what we call a black box around that simple, ugly mechanism.
Okay, let's unpack the black box. This seems like stage one in the anatomy of the lie, the disguise.
It is. It's the intellectual camouflage. You need a plausible-sounding story that explains why you are making these incredible returns when nobody else can. And that story almost always relies on complexity and secrecy.
This is what our sources call verbal masking, right?
Yes. The operator uses terms that sound incredibly impressive, but are intentionally vague and impossible to verify. Things like proprietary hedge futures trading, or high-yield international investment programs, or offshore foreign currency arbitrage.
I see this constantly in the crypto space, which I know we'll get to. Algorithmic stablecoin yield farming on a layer 2 protocol.
It sounds like you know what you're talking about.
But I don't. And I think that's the trap, isn't it? If I ask you to explain it and you fire back with a sentence like that, I don't want to look stupid by saying, I have no idea what you just said.
That is the single most important psychological trigger they exploit. Your social anxiety, your insecurity about finance. If I tell you my strategy is a proprietary algorithm or that it's a trade secret, I've just done two incredibly powerful things.
Okay, what are they?
First, I've completely shielded myself from any real due diligence. You can't ask to see my books because they're secret.
Right.
But second, and this is the real genius of it, I've made you feel special. You're not just an investor. You're being let in on a secret. You're getting access to the secret sauce.
So the total lack of transparency becomes a selling point. I can't possibly tell you how I make the money because then everyone would do it. and that opportunity would vanish.
Precisely. And once you've bought into that black box, the second stage kicks in. This is the cascade effect.
This is where the money starts moving.
This is where the illusion becomes reality for the first investors. The operator takes your money, and maybe a month or a quarter later, they do one of two things. They either mail you a check for your profits, or, more likely these days, you log into a slick-looking website and see a number on a screen.
And the number has gone up. My $10,000 is now $11,000.
And that's the hook. That's the moment the scheme goes from a promise to, in your mind, a proven fact. The dopamine hits. It works.
It validates the risk I took. All my skepticism just melts away because, hey, look, there's the proof.
And this is the critical turning point. This is where the victims completely unwittingly become accomplices. Because what's the very first thing you do when you find an investment that's actually truly paying out 15 or 20% a year?
I tell people. I tell my brother, I tell my best friend from college. I'd feel guilty if I kept it to myself. I feel like I was hoarding this amazing opportunity.
You become the unpaid and most trusted recruitment arm of the entire fraud. You are now doing the operator's work for him, and you're far more effective than he could ever be.
Because the recommendation is coming from a place of trust. My brother trusts me.
Exactly. This solves the operator's biggest problem, which is customer acquisition. But now he has another even bigger problem.
Cash.
Actual liquid cash. If everyone tries to take their profits out in real money all at once, the whole house of cards collapses overnight. So he has to deploy a whole suite of retention tactics.
The sources call this the rollover pressure. And I found this part fascinating because it plays on greed, but it also uses a legitimate financial concept against you.
It weaponizes the power of compounding. Albert Einstein supposedly called compounding the most powerful force in the universe.
And the scammers know it.
They absolutely know it. They'll call you up and say, look, your account generated $2,000 profit this quarter. I can cut you a check right now. But if you just leave it in the fund, roll it over, next quarter you'll be earning a return on your principal and on that profit.
And since I believe the black box is a magic money machine, of course I leave it in. Why would I take out $2,000 when I can turn it into $4,000?
And in that moment, you've just traded real, spendable cash for a few extra pixels on a computer screen.
And that costs the operator absolutely nothing. He can just type a new number into the database for my account. You have $1 million, you have $5 million. As long as you don't ask for the actual check.
He's perfectly safe.
Yeah.
And to make sure you don't ask, they'll often build in incentives, lock-in periods. If you commit to keeping your money with us for 3 years, we'll bump your guaranteed rate from 10% to 12%.
It's all about buying time, kicking the can down the road. But what if I really do need the money? You know, my kid's tuition is due, or I have a medical emergency. I have to cash out.
This is where the operator has to be very, very clever. This is the illusion of liquidity. If you're a relatively small investor and you ask for your money back, they will almost always pay you.
Immediately.
Immediately, and with a smile. They'll wire it to you the same day.
But why? Wouldn't they want to hold on to every last penny? That seems counterintuitive.
Because they're not just losing your $20,000. They're making a strategic investment. They're buying your testimonial.
Oh, I see.
Because what do? You go back to that same circle of friends you recruited and you say, hey, I was a little worried, but I had to take some money out and there was no problem at all. The funds were in my account the next day. This thing is legit.
You calm the herd. You prevent a panic.
You prevent the run on the bank.
Yeah.
They will happily sacrifice a little bit of cash to protect the main pot. It's a calculated loss.
Wow. Now, before we get into the history, there's one specific type of Ponzi that I found really disturbing in the research. The accidental Ponzi.
This is a frightening one.
Because we have this image of the con artist as, you know, a predator, someone who plots this out in a dark room from day one. But that's not always how it starts, is it?
No. And this is what's so scary. It can happen to people who start out with good intentions. Imagine a hedge fund manager. He's running a perfectly legitimate fund. He has real clients. He's making real trades. But he's under enormous pressure to perform. And then 1 month, he makes a huge, catastrophic bad bet. The market turns against him. He loses 30% of the entire fund's value in a week.
So he's staring at his screen, and he knows that in 2 weeks, he has to send out the quarterly statements to all his investors.
Telling them he just vaporized a third of their retirement savings. And his ego can't handle it. Or he's just terrified they'll all pull their money out and his firm, his career, will be over.
The shame must be immense.
So he makes a choice, a fateful choice. He says to himself, you know what, I'll just I'll just fudge the numbers. Just for this one quarter, I'll send out statements saying we were flat, no gain, no loss. And then over the next 3 months, I'll take a really risky, high-leverage bet. I'll make it all back, and I can fix the books before the next audit. No one will ever know.
That's make-good theory. He's not trying to steal. He's trying to fix his mistake without admitting failure. He's borrowing from the truth.
Exactly. But what happens? That high-risk, desperate bet fails too. Now the hole isn't 30% deep. It's 60% deep. Now he has to lie on the next statement. He has no choice. And suddenly, without even realizing the moment it happened, he's not a hedge fund manager who made a mistake anymore.
He's running a Ponzi scheme.
He's running a Ponzi scheme. Because now, when an old investor wants to withdraw money, the real money isn't there. He has to use capital from a new investor to pay them out. It's a terrifyingly slippery slope from professional pride and incompetence into outright criminality.
That's a chilling thought. It means you're not just looking for the obvious predators. You could be investing with someone who's just desperate and in way over their head.
And who thinks they can outsmart the market just one more time.
All right, let's step back in time. Because for all his fame, Charles Ponzi was basically a latecomer to his own party. He didn't invent this. He just had better PR.
He had incredible branding. If we're being historically accurate, we should probably be calling these Bissitter schemes.
Adele Spitziter. I had never heard of her before this deep dive, and her story is just... it's wild. We're in Germany, right? Late 1860s.
Munich, to be precise. The Kingdom of Bavaria. And Adele Spitzer was not a financier. She was an aspiring actress, and apparently not a very good one. She was in debt, struggling to make ends meet.
So how does a struggling actress start a bank?
She realized that borrowing from established banks was difficult, but maybe borrowing from ordinary people would be easier, especially if she promised them something the banks would never dream of offering. She started what became known as the Dachauer Bank in 1869.
And her hook wasn't some complex arbitrage scheme. It was just an insane interest rate.
An impossible interest rate. She offered 10% interest per month.
Per month. That's what, 120% a year? Simple interest? You're more than doubling your money in a year.
It's economic fantasy. But for the first investors, she made it real. She'd pay them out in cash, often very publicly. There are contemporary accounts of her holding court in her lavish apartment with sacks of coins and banknotes visibly piled up as she handed out payments to a line of happy customers.
And who are these customers? Not the aristocracy, I take it.
No, and that was her genius and what made the collapse so tragic. She targeted the working class. Farmers from the countryside, maids, servants, small shopkeepers, people who were ignored by the traditional banking system. She positioned herself as their champion.
A woman of the people.
Exactly. She became a beloved folk hero. They called her the angel of the poor. And she played the part. She opened soup kitchens. She donated lavishly to churches and charities.
She was buying legitimacy with stolen money, creating this public persona of a benevolent matriarch who was fighting the greedy established banks on behalf of the little guy.
It was a masterclass in public relations and psychological manipulation. People trusted her not because of her financial acumen, but because she seemed to care about them.
And the fall was just as spectacular as the rise.
As it always is. The financial press and the legitimate banks started asking very pointed questions. The math simply didn't work. As scrutiny grew, the flow of new money started to dry up. She couldn't make the interest payments. A panic started, and she was arrested in 1872.
And the aftermath?
It was devastating. The collapse was so profound, it reportedly triggered a wave of suicides in Bavaria. It wiped out the life savings of thousands of working-class families.
It's the exact same pattern we see over and over, but let's jump across the Atlantic. A decade later, in the U.S., Sarah Howe and the ladies' deposit. This one is it feels particularly cruel.
It's a very targeted, very cynical case of affinity fraud. This is Boston in the 1880s, and Sarah Howe's background was not in acting, but in fortune-telling.
So she was already in the business of selling illusions.
You could say that.
Right.
And she devised a scheme that was exclusively for women, and not just any women, but specifically unmarried women, spinsters, and widows.
We have to remember the context here. In the 1880s, a woman's financial life was incredibly restricted. They often couldn't open their own bank accounts. They couldn't own property in the same way. They were completely shut out of the investment world.
They were a financially vulnerable and underserved population. Howe saw that vulnerability and exploited it perfectly. She opened the ladies' deposit, and her promise was 8% monthly interest.
Still an impossible number.
Of course. But the real hook, the real genius of her scam was the exclusivity. It was a financial sanctuary for women, run by a woman. It felt safe. It felt like a club that was finally looking out for their interests.
And the research notes say she cultivated a specific image, too.
Yes, she didn't present herself as a flashy, wealthy financier. She dressed very plainly, almost in a Quaker style. She projected an image of piety, humility, and trustworthiness. She wasn't selling glamour, she was selling stability.
So what was her black box? What was the lie that explained the 8% a month?
It was a clever one. She claimed the entire enterprise was backed by a silent, benevolent Quaker charity.
Ah, there's the Quaker connection.
Right. She told her clients that a group of wealthy, charitable Quakers wanted to help these unfortunate women, so they were subsidizing the high interest rates. It was a complete fabrication, of course. There was no charity. The only money coming in was from new depositors.
And it was the press that eventually brought her down.
It was. The Boston Daily Advertiser did some real investigative journalism. They looked into her past and found a history of fraud. They searched for this mysterious Quaker charity and, of course, found nothing. When their expose was published, the run on the bank began.
How much did she get away with?
She'd taken in around $500,000, which in 1880 was an astronomical sum of money. She ended up serving 3 years in prison. But she really wrote the playbook for what we now call affinity fraud.
It's just amazing. Scammers are like viruses. They just adapt to the host environment. They find the cultural weakness, struggling farmers, marginalized women, and they design the attack specifically for that target.
And that finally brings us to the man whose name is on the tin. Charles Ponzi, Boston, 1920.
So why him? Spitzer's scam was huge. Howe's was devious. Why do we all say Ponzi's scheme was his just that much bigger?
It was bigger and it was much, much faster. But the real reason his name stuck was that Charles Ponzi was a natural-born master of the media. He operated in the Roaring '20s, right after World War I.
Yeah.
It was a time of huge economic change and speculation. And his black box, it was a work of art because it was technically grounded in a real, verifiable thing.
The International Reply Coupon.
The humble IRC. Let's explain this because it sounds incredibly boring, but it's the heart of the story.
Please do.
Okay, back then, if you wanted to send a letter to someone in, say, Italy, and include the postage for them to write you back, you couldn't just put a U.S. stamp in the envelope. You buy an international reply coupon at your post office, you send it to Italy, and your friend there can exchange it for an Italian stamp.
It's a voucher, basically.
It's a voucher for postage. And Ponzi's grand idea was arbitrage, buying something low in one market and selling it high in another. Because of the hyperinflation in Europe after the war, the Italian lira was incredibly weak against the U.S. dollar. So, in theory, you could buy an IRC in Italy for the equivalent of 1 U.S. cent and then redeem it in Boston for a 5-cent U.S. stamp, a 400% profit.
Okay, that actually sounds plausible. So what was the problem? If the arbitrage was real, why was it a scam?
This is the critical point. The math worked on a small scale, but it was logistically impossible to scale up. Think of it this way. To generate a meaningful profit, you need to deal in huge volumes.
Thousands, millions of these little paper coupons.
Exactly. To pay the returns he was promising, which was 50% in 45 days, on the millions of dollars that were pouring in, he would have needed to purchase and ship more coupons than actually existed in the entire world. The number of ships required would have been a fleet. It was a physical impossibility.
Did he know that from the start?
The evidence suggests he figured it out very, very quickly. He might have started with a legitimate, if naive, idea, but within a week or two, he realized the logistics were a nightmare, so he just stopped buying the coupons.
But he didn't start taking the money.
He did not stop taking the money. He just started using the fire hose of cash from new investors to pay off the early ones with a handsome profit.
And because he paid them, Boston went absolutely insane for him.
It was a frenzy, a full-blown mania. There were pictures in the papers of lines stretching for blocks outside his office, cops, factory workers, rich socialites. Everyone was investing. He was hailed as a financial wizard, a hero of the common man.
He bought a mansion, a bank.
He was living the high life. He was the toast of the town. Until, just like with Sarah Howe, a newspaper, this time the Boston Post started to do the math.
The math always wins.
The math is undefeated. An analyst for the Post calculated that to cover the investments Ponzi had taken in, there would need to be something like 160 million postal coupons in circulation. They called the Postal Service. The actual number in the entire world was about 27,000.
That is a smoking gun. You can't argue with that.
You cannot. The story broke, the panic started, and the whole thing collapsed in a matter of days. He was ruined, went to prison, was eventually deported, and died broke. But he left behind a powerful legacy. His name became synonymous with the lie, that if the returns are high enough, people will desperately want to believe.
Which is a perfect segue. Because this isn't just about history. I want our listeners to be armed. If a modern-day Charles Ponzi slid into your DMs or called you up, what are the red flags? We've got a great checklist here from the SEC. Let's run through them.
Okay. The first one is the most obvious, but it's also the one people are most willing to overlook. It's high returns with little or no risk.
The word guaranteed should set off alarm bells.
It should be a fire alarm with sprinklers. In the real financial world, risk and return are inextricably linked. They're two sides of the same coin. If you want a perfectly safe investment, you buy a government bond and you get, 4% or 5%. If you want a chance at a 20% return, you have to accept the risk that you could lose all your money in a startup or a volatile stock.
So anyone offering you high guaranteed returns is breaking the fundamental laws of finance.
They are lying. Full stop. It is an economic impossibility.
Okay, red flag number 2. Overly consistent returns. This one is the Madoff signature.
This is a bit more subtle, but it's a huge tell. If you look at a chart of any real market index, like the S&P 500, it looks like a mountain range. It's jagged, it goes up, it goes down. There are good months and bad months.
Right. It's volatile.
If you look at the performance chart for Bernie Madoff's fund, it was a perfectly smooth, straight line, angled up at 45 degrees. Month after month, year after year, it went up by about 1%. The market crashes in 2000, Madoff is up 1%. The market booms, Madoff is up 1%.
But isn't consistency what investors want? Why is that a red flag?
We want it, but it doesn't exist in nature. No real trading strategy works perfectly in all market conditions. If an investment fund never has a down month, it's almost certain proof that the numbers are being fabricated. It means they're not actually trading in the market, they're just typing numbers into a spreadsheet. Got it. Okay, number 3, unregistered investments and unlicensed sellers.
This goes right back to the black box. Ponzi schemes thrive in the dark. If you register an investment with a regulator like the SEC in the US or the FCA in the UK, you have to provide audited financial statements. You have to have transparency.
And transparency is the enemy of the scammer.
It's their kryptonite.
Yeah.
So they operate outside the system. They sell things like private placements or exclusive offshore funds. The first thing you should always do is check the regulator's public database. If the person selling the investment isn't licensed or the investment itself isn't registered, walk away.
What about this idea of affinity fraud? We touched on it with Sarah Howe.
This is one of the most dangerous and effective tactics. It's less about the investment itself and more about the sales channel. Scammers will deliberately target tight-knit groups.
Churches, for example. Churches are a huge one. But also immigrant communities, professional associations, country clubs. The chronologist Marie Springer, who's an expert on this, points out that we instinctively lower our intellectual guard when a pitch comes from someone inside our own trusted circle.
Oh, Dave from my church group told me about this. Dave's a good guy. He wouldn't steer me wrong.
And Dave probably isn't trying to steer you wrong. Dave is most likely a victim himself. He's that unwitting accomplice we talked about. But because you trust Dave, you transfer that trust to the scammer he introduces you to. You don't ask the hard questions.
You don't ask to see the audit because it feels rude. It feels like you're questioning your friend's judgment.
Precisely. And that social pressure is what the scammer is counting on.
Springer also mentioned some really specific procedural red flags, things like weird payment methods.
Yes, this is a very practical one. If you're investing in a company called, say, Global Quantum Fund, Inc., the check should be made out to Global Quantum Fund, Inc.
Makes sense.
If the person tells you, oh, for tax purposes, just make the check out to me personally, Bob Smith, or wire the money to this personal account in another state.
Red flag.
Huge red flag. Or, very common in the crypto world, just send the crypto to this anonymous wallet address. No, legitimate investment firms use corporate bank accounts and official custodians. Any deviation from that is a sign that something is wrong.
It all sounds so obvious when we lay it out like this, but I can see how in the moment, with the promise of huge returns and the pressure of this opportunity won't last, people just rationalize it.
They do. Greed and the fear of missing out are incredibly powerful emotions. They can short-circuit the rational part of your brain.
So let's talk about the end game, because our outline calls this the mathematical certainty. A Ponzi scheme isn't just likely to fail, it's guaranteed to fail.
It's a mathematical necessity. It's like a shark. It has to keep moving forward or it drowns. The scheme creates an exponentially growing liability. Every single day, it owes more and more money to its existing investors. To cover those promised payments, it needs a constantly growing inflow of new victims.
But the pool of potential investors isn't infinite.
The population of the Earth is finite. You will eventually run out of new money. It's not a question of if, but when.
So how does it typically end? Our notes lay out 3 common collapse scenarios.
Scenario 1 is what you could call the vanishing act. This is when the operator is smart, or at least not delusional. He's watching the numbers. He can see the math turning against him. He realizes that next month, the payouts he owes are going to be bigger than the new investments he expects to come in.
The tide is about to turn.
So before the checks start bouncing, he executes his exit plan. He wires all the remaining money in the pot to an offshore account in a country with no extradition treaty, packs a bag, and disappears.
The classic take the money and run.
Exactly. Scenario 2 is the slow death. This is more common. Recruitment starts to slow down. Maybe there's a downturn in the economy or some negative press starts to circulate. The operator can't make the full payments anymore, so he starts making excuses.
Oh, we're having some technical difficulties with our payment processor. We're upgrading our banking systems.
All those classic lines. Investors get nervous. They start asking not just for their profits, but for their principal back. The operator might pay off a few of the loudest complainers to try and quell the panic, but that just drains the remaining funds even faster. It becomes a death spiral that ends in a messy, chaotic collapse.
And then there's scenario 3, the sudden shock.
This is 2008. This is the global financial crisis.
Yeah.
And this is what finally brought down Bernie Madoff.
So his scheme might have continued if the wider economy hadn't collapsed.
It's very likely. He might have been able to keep the illusion going for another 5, maybe even 10 years. But when the entire market crashed, his wealthy investors, who thought their money with Madoff was their safe, stable anchor, suddenly needed cash. They had losses elsewhere. They had margin calls. So they started treating Madoff's fund like an ATM.
But the ATM was empty.
The ATM was a painted box with nothing inside. A massive, unprecedented wave of redemption requests hit him all at once, billions of dollars, and he simply couldn't pay. The run of the bank exposed the decades-long fraud in a matter of weeks. It's like Warren Buffett says.
Only when the tide goes out do you discover who's been swimming naked.
And Madoff was caught with no swimsuit.
And once the collapse happens, no matter which scenario plays out, the money is just gone.
It's gone. It was never invested in any real assets. It was either spent on the operator's lavish lifestyle, the jets, the yachts, the mansions, or it was paid out to earlier investors who cashed out along the way. The recovery process for the final victims is long, painful, and they typically get back only pennies on the dollar, if anything at all.
We've covered the history, we've dissected the classic mechanics, but we have to talk about how this scam has evolved for the 21st century. Technology hasn't killed the Ponzi scheme. It's given it a massive upgrade.
It's put it on steroids. Welcome to the world of crypto Ponzis.
Now, let's be very clear here. We are not saying that all of cryptocurrency is a Ponzi scheme. That's a huge and a complex debate. But you have to admit, the crypto space has been a perfect breeding ground for this type of fraud.
It's the perfect petri dish.
Yeah.
Just think about the key ingredients we've been talking about. You need a complex black box story.
Check. Blockchains, smart contracts, decentralized finance, tokenomics. It's the ultimate shield of jargon.
You need the promise of impossibly high returns.
Double check. People talking about 10x, 100x returns is just normal conversation in that world.
And you need a lack of clear regulation and oversight.
Triple check. It's the Wild West, so you have all 3 ingredients in spades.
It's a scammer's paradise. If I say I'm doing arbitrage on postal coupons, you can eventually check the facts. If I say I'm leveraging a cross-chain liquidity protocol to generate yield through impermanent loss hedging, most people's eyes just glaze over and they reach for their wallet.
Let's talk about a huge real-world example, TerraUSD in Luna, May of 2022. This was a cataclysmic event in the crypto world, and Wired magazine flat out called the mechanics Ponzinomics.
It's a fascinating and tragic case study. TerraUSD or UST was what's called a stable coin. Its whole purpose was to always be worth exactly $1.
Right, a safe harbor in the volatile crypto markets.
But unlike other stablecoins that are supposedly backed by actual dollars in a real bank vault, Terra was an algorithmic stablecoin. It used a complex relationship with a sister token, Luna, to magically maintain its $1 peg. That was the black box.
And what was the hook? What was the impossible promise?
The hook was a savings protocol built on Terra called Anchor. And Anchor offered a nearly 20% annual percentage yield if you deposited your Terra stablecoins there.
20%.
Yeah.
On a stable dollar equivalent asset, in a world where your bank was paying you 0.1% interest.
You can see the appeal. Billions upon billions of dollars poured into this system. But the critical question no one wanted to ask was, Where is that 20% yield coming from?
Right. What business is generating that profit?
There was no business.
Hmm.
The yield was being artificially subsidized by the project's founders and by the constant inflow of new money from people buying Luna and Terra to chase that 20% yield. The system required exponential growth just to stand still.
So it was robbing new investors to pay the interest to the old ones.
Structurally, yes.
Yeah.
And when the market turned and confidence wavered, the growth stopped and the whole thing entered a death spiral. The run of the bank happened digitally at the speed of light. Both tokens crashed to essentially zero within a few days.
And something like $60 billion of perceived value was just erased?
Vaporized. It wasn't a classic Ponzi in that one guy ran off with the money, but the economic structure was that of a Ponzi. It relied on new money to pay the promised returns.
And then you have the much more blatant old-school Ponzis that just wear a crypto disguise. BitConnect comes to mind.
Oh, BitConnect. It's almost a caricature now, but it was huge. It was a classic high-yield investment program.
The memes were incredible.
They were. The pitch was, you give them your Bitcoin, and in exchange you get their special BitConnect coin. You then lend this coin to their proprietary volatility trading bot.
The black box.
And this magical bot would pay you an average of 1% interest per day.
Per day. That's, let me do the math. Compounded, that's an insane number. It's thousands of percent a year.
It would make you the richest person in the history of the world in about a decade. It was transparently impossible, but people threw money at it because the excuse was, it's crypto, the old rules don't apply.
And of course, the trading bot didn't exist.
Of course not. It was a straight-up Ponzi. New Bitcoin coming in was used to pay the interest to older members. It collapsed spectacularly, and the founders were indicted.
What's interesting to me, though, is how these schemes can also adapt to the most conservative, risk-averse investors. It's not just for tech bros chasing moonshots. Look at Alan Stanford.
Stanford is the polar opposite of BitConnect. He was the picture of old-school financial respectability. Sir Alan Stanford, a knighted Texan billionaire with a bank based in Antigua.
And his investment vehicle of choice wasn't some newfangled crypto coin. It was the certificate of deposit, the CD.
The single most boring, safe investment on the planet. The thing your grandmother buys at her local bank.
And that was his genius.
It was. He wasn't promising 1% a day. He was just offering CDs from his offshore bank. It paid an interest rate that was consistently 2%, 3%, maybe 4% higher than what you could get from a U.S. bank.
It felt safe. It felt plausible. It didn't trigger the too good to be true alarm.
Exactly. The pitch was, we're an offshore bank, we have lower overhead, we're more efficient, so we can pass those savings on to you in the form of a slightly better rate. It felt smart, not greedy.
And that veneer of plausibility and safety allowed him to run a multi-billion-dollar Ponzi scheme for over a decade.
He was just taking new CD deposits and using them to pay the interest on the old ones. But because the promised returns weren't astronomically high, the cash burn was much slower. He was able to sustain the illusion for a very, very long time.
It just proves you have to be skeptical of everything, the flashy and the boring.
You have to look under the hood of the vehicle, no matter how safe it looks from the outside.
I want to spend a moment clarifying some terms because we hear pyramid scheme and Ponzi scheme thrown around almost interchangeably, but they are structurally different, aren't they?
They are. They're both forms of investment fraud that rely on new money, but the mechanics of how the money flows and how the victims participate are quite different.
So what's the core distinction?
The main difference is the role of the investor. In a Ponzi scheme, the operator is the central hub. It's a hub-and-spoke model. I, the operator, recruit you. You give me your money, and then your role is completely passive. You just sit back and wait for me to send you statements and checks.
I'm an investor. I'm not a participant in the business.
Right, but in a pyramid scheme, you are the business. I recruit you, but you don't make any money by just giving me cash. You only make money if you go out and recruit 5 more people who pay to join. And they, in turn, only make money by recruiting 5 more people each.
So it's active. I have to become a salesperson. My primary activity is recruitment.
Correct. Think of a multi-level marketing company, MLM, where there's no actual product being sold, or the product is just a flimsy excuse. In a pyramid scheme, the money flows directly up the chain from the new recruits at the bottom to the people in the layers above them.
Okay, so that's the structural difference. What about the story, the black box?
That's the other key difference. A Ponzi scheme always has a cover story about some kind of brilliant, esoteric investment strategy. Arbitrage, secret algorithms, hedge funds. It claims the profits come from outside the system. A pyramid scheme is usually honest about its mechanics. It explicitly states that your earnings will come from the fees paid by the people you recruit.
So which one collapses faster?
Pyramids, almost without exception, collapse much faster. The reason is pure mathematics. They require exponential growth in the number of participants. If every person has to recruit, say, 6 new members, by the time you get to the 13th layer of the pyramid, you need more participants than there are people on Earth.
You just run out of humans.
You run out of humans very quickly.
Yeah.
Ponzis can survive much longer, especially if they have a wealthy client base, because they can just convince the same group of people to roll over their imaginary profits for years and years, which minimizes the need for a constant, massive influx of new bodies.
Okay, that makes sense. Now let's get a little more philosophical. We've been talking about clear-cut fraud. What about economic bubbles? The dot-com bubble in the late 90s, the housing bubble before 2008, are those Ponzis?
This is a fantastic and very important debate. The Nobel Prize-winning economist Robert Shiller has a great term for them. He calls bubbles naturally occurring Ponzi schemes.
Naturally occurring, so like a tornado or a forest fire. An act of nature.
Meaning there's no central mastermind. There's no single Charles Ponzi orchestrating the whole thing. It's a decentralized collective delusion.
Explain that.
In the housing bubble, people weren't buying houses for their fundamental value as shelter. They were buying them based on the belief that prices would keep going up forever and that they could sell the house to a greater fool down the line for a profit.
The value wasn't in the asset itself, but in the expectation of future price appreciation.
Precisely. And that psychology is identical to a Ponzi. The belief that you can get rich from an asset that isn't generating any underlying value simply because new money will keep flowing into it.
So in a bubble, we are collectively scamming ourselves.
In a way, yes. But there are 2 crucial distinctions. The first is legality. Participating in a market bubble, buying an overpriced stock or a house, isn't a crime. Orchestrating a Ponzi is.
Right.
The second, and more important distinction, is what happens after the crash. When a bubble bursts, the underlying asset usually still has some intrinsic value. Your house might be worth half of what you paid for it, but it's still a house. You can live in it. The dot-com company's stock might be down 99%, but the company might still exist. In a Ponzi scheme, the underlying investment was a complete fabrication. When it collapses, there is nothing left. The value is zero.
Okay, that's a very clear line. We're heading into our final section here, and I want to touch on some deep theory. The term Ponzi finance comes up in our notes. This is from the economist Hyman Minsky.
Yes. Hyman Minsky is one of the most important economists for understanding why financial crises happen. And he wasn't talking about criminal fraud. He was using the term Ponzi as an analogy to describe a certain type of very risky borrowing within the legitimate economy.
Okay, so what did he mean by it?
Minsky categorized borrowers into 3 types based on their ability to pay back their debts. It's a spectrum of financial stability.
Let's break them down.
Okay, the first and safest type is the hedge borrower. This is a company that borrows money to, say, build a new factory. The cash flow from that factory is expected to be enough to pay back both the interest on the loan and the original principal over time.
That's healthy. Sustainable.
Completely. The second type is the speculative borrower. This borrower's cash flow is only enough to cover the interest payments, but not the principal. They are counting on being able to refinance or roll over the jet when it comes due.
So they're not paying it down, they're just treading water.
They're treading water. It's riskier, but it can be manageable in a stable economy where credit is easy to get.
And then there's a third type.
And then there's the Ponzi borrower. This is a firm or an individual who has taken on so much debt that their income can't even cover the interest payments. They have to borrow new money just to make the interest payments on their old money. They are fundamentally insolvent, and their debt is growing exponentially. They can only survive as long as someone is willing to lend them more and more money.
They're just digging the hole deeper and deeper.
And Minsky's great insight was that long periods of economic stability and prosperity breed complacency. Lenders and borrowers take on more risk. The whole economy gradually shifts from being dominated by safe hedge financing towards risky speculative and even Ponzi financing. Eventually, something spooks the market, credit dries up, the Ponzi borrowers collapse, and that triggers a domino effect of crisis. He called it a Minsky moment.
That sounds uncomfortably familiar, and it leads to this very provocative idea in our notes about the Ponzi game in government.
Ah, yes. This is very debated economic theory, but the parallel is undeniable. If you look at the sovereign debt of most major developed nations, the US, the UK, Japan, how do they handle their debt?
Well, when a government bond matures and they owe $1 billion to the bondholder.
Do they pay it off using a surplus of tax revenue? Almost never. They simply issue a new bond and use the money from the new bond sale to pay off the holder of the old maturing bond.
They're rolling over the debt. Structurally, that's identical to what a Ponzi borrower does.
Structurally, yes. But, and this is the trillion-dollar but, there was one fundamental difference. Charles Ponzi was just a man. The United States government has the power to tax 330 million people. And, crucially, it has a printing press. It can create new money.
So the argument is that a government can sustain this game indefinitely as long as the underlying economy continues to grow and people continue to have faith in the currency.
That's the argument. That it's not a fraudulent Ponzi, but a system built on perpetual growth and, above all, confidence. If that confidence were to ever break on a global scale, well, that would be a Minsky moment for the entire world.
A deep dive for a much scarier day. Okay, before we wrap up, there is one last crucial point for our listeners. It's a real sting in the tail. It's the concept of the innocent beneficiary.
This is so important. We always focus on the victims who lose everything at the end. But what about the people who got in early and got out with a profit?
Right. They think they're the smart ones. They won.
Let's paint a picture. You invested with Bernie Madoff in 1995. For 10 years, you got great returns. In 2005, you cashed out your entire account, your original investment, plus, say, $1 million in profit. You use that money to buy a vacation home, put your kids through college. You feel like a genius.
Then the scheme collapses in 2008, but I'm fine, right? My money is out. I'm safe.
You are not safe. In the eyes of the law and the bankruptcy court, that $1 million you took out was not legitimate profit. It was other people's money. It was stolen funds that rightfully belonged to the victims who came in after you.
So what happens?
The court-appointed trustee who is trying to recover assets for the victims can sue you. It's called a clawback. They can legally force you to return any money you withdrew that was in excess of your original investment.
Wait, they can come after me years later, even if I had absolutely no idea it was a scam?
Yes. Ignorance is not a defense. If you were a net winner in the scheme, you can be compelled by a court to pay back those winnings so they can be redistributed to the net losers.
So you could be forced to sell that vacation home. You could go into debt to pay back money you spent a decade ago.
It happened to hundreds of Madoff investors. People who had long since retired, who had given money to charity, were suddenly faced with financial ruin years after they thought they were safe.
That is a truly chilling realization. It means that if you get involved in one of these schemes, even unknowingly, there's no way to win. You either lose your shirt when it collapses, or you win for a while and then lose it all when the lawyers come knocking.
It proves the old adage. There really is no such thing as a free lunch. If the profits were an illusion, the wealth was an illusion. And eventually, reality always balances the books.
So after this entire journey from 19th century Munich to the cryptosphere, what's the ultimate takeaway for people listening today?
For me, it all comes down to abandoning magical thinking and embracing critical thinking. We live in an incredibly complex world, financially and technologically. The black box is everywhere now. But the fundamental laws of economics have not been repealed. Value must be created from something. Risk and reward are always related. If anyone, anywhere, ever tells you they have a machine that creates high returns with no risk, they are selling you an illusion.
And I'll leave you with this final thought to chew on. We spent this whole time talking about how these fraudulent schemes are built entirely on a foundation of trust and belief. They only work as long as everyone believes they work. But if you zoom out far enough, how different is that really from our entire financial system? A dollar bill is just a piece of paper with some ink on it. A stock price is just a number everyone collectively agrees on for a moment. It all functions on a shared belief system.
It's a spectrum. On one end, you have tangible value and provable truth. On the other end, you have outright fraud. The vast, murky middle ground where confidence and collective psychology create reality is where we all have to navigate.
So the question to ask yourself is, when does confidence become a con? Check the audits, ask the hard questions, and if it sounds too good to be true, it is. Thanks for diving deep with us.
See you next time.